Are you ready for what's coming? The entire crypto market is holding its breath for today's massive Fed decision, and analysts are drawing parallels to the 2024 rate cut that sent Bitcoin on a 77% tear. We're seeing powerful technicals line up, with a giant inverse head and shoulders pattern pointing to a potential $127,000 Bitcoin target. At the same time, experts are calling for a massive altcoin season in Q4, fueled by trillions of dollars waiting to flood the market. This isn't just hype. Institutional giants like BlackRock are making huge moves into tokenizing real-world assets, and corporate treasuries are quietly stacking billions in Ethereum. From AI blockchains built for incredible speed to state-issued stablecoins, the game is changing fast. You need to know if this is the final consolidation before a new all-time high or a trap before a major correction. The next 48 hours could define your portfolio for the rest of the year. In the latest video from Altcoin Daily, Michael Heinrich, the CEO of Zero G Labs, talks about his project, which he describes as the biggest and quickest AI Layer 1 blockchain. He explains that Zero G is creating the necessary foundation for building AI applications on-chain, comparing it to a decentralized version of AWS and OpenAI combined. A big reason for its existence is the need for speed and scale, as current blockchains like Ethereum and Solana aren't equipped to handle the massive data loads of AI. Michael points out that Zero G can manage about 50 gigabytes per second for each consensus layer, a huge leap from what's currently available. The discussion in the video aligns with a powerful and growing trend in the crypto market. The AI sector has been showing significant strength recently. In the last month alone, the AI crypto category saw a 17.4% rise in market capitalization, outperforming other sectors. This comes as institutional money is flowing into AI data centers, signaling long-term conviction from major players. The idea of a specialized layer 1 for AI, like Zero G, is compelling because it addresses a clear technical bottleneck. Even the Ethereum Foundation just announced a new team dedicated to building a decentralized AI stack, acknowledging that networks need to evolve to support intelligent agents. In the latest video from the Crypto Rover channel, the host prepares viewers for a volatile day driven by the upcoming Federal Open Market Committee (FOMC) meeting. The discussion centers on the expected interest rate decision and, more importantly, the release of the dot plot, which reveals the Federal Reserve members' future interest rate projections. The video points out that historically, the days following an FOMC announcement bring large, explosive moves in the market. The video's analysis, particularly its price points like a $16,700 resistance level, indicates it was recorded some time ago. As of mid-September 2025, the market has evolved considerably. Bitcoin is currently trading around $116,000, and Ethereum is holding near $4,500. The FOMC meeting is indeed scheduled for today, September 17, 2025, and the market widely anticipates a rate cut. Current market sentiment is shaped by recent cooling inflation data, which has increased speculation from a guaranteed 25 basis point cut to a small but possible 50 basis point jumbo cut. Such a move would likely inject further momentum into risk assets like crypto. The video's core idea that Fed policy creates volatility holds true. In fact, markets have already seen an uptick in anticipation of the decision. The M2 money supply continues to be a relevant metric, with its current global value sitting around $95.4 trillion. While the video's specific price predictions are outdated, its fundamental thesis connecting monetary policy to crypto market movements remains highly relevant to today's landscape. The market is now contending with resistance closer to the all-time highs near $124,000, a very different picture than the one painted in the video. In the latest video from the Crypto Tips channel, the host explains a practical strategy for taking profits called laddering exits. The main point is that making gains is only half the battle. Keeping them is what's truly difficult. Instead of trying to time the market and sell at the absolute peak, which is nearly impossible, you should sell your holdings in small, predetermined chunks as the price rises. This approach takes emotion out of the equation, so you're not making decisions based on greed or fear. For instance, if you bought Bitcoin at $40,000 and the price is now over $110,000, you could plan to sell 20% at $120,000, another 20% at $150,000, and maybe a smaller portion at $180,000, while leaving some in case the price goes much higher. To set these targets, you can use technical tools like Fibonacci extensions on platforms like TradingView. The speaker also stresses the importance of considering the tax implications of each sale, as each profit-taking step is a taxable event. He suggests using services like CoinTracker or Coinly to keep records straight. Ultimately, this disciplined method helps you lock in gains, provides peace of mind, and gives you cash to use for future opportunities. The video's advice on laddering exits is especially relevant right now. Bitcoin is currently trading around $116,000, which makes the video's hypothetical price targets of $120,000 and $150,000 feel very close to reality. The general market sentiment is leaning towards bullish, with social media discussion showing a high degree of optimism, especially with expectations of a Federal Reserve rate cut. This kind of environment is exactly where a predefined exit strategy becomes most useful, as it's easy to get caught up in the hype and hold on for too long. In the latest video from Lark Davis, the main focus is on BlackRock's significant moves into tokenizing real-world assets, RWAs. This means taking things like stocks, bonds, and ETFs and putting them on the blockchain. BlackRock CEO Larry Fink has been very open about this, stating that he believes every financial asset can eventually be tokenized. This isn't just talk. A senior reporter from Bloomberg confirmed that the company is actively figuring out how to make tokenized ETFs a reality. Lark's breakdown of the RWA tokenization trend is timely, and the market has only reinforced his point since the video was made. The total value of tokenized assets has already climbed past the $30 billion mark mentioned, with some reports now placing the market cap, including private credit and treasuries, well over $50 billion. This shows the momentum is real and accelerating. BlackRock itself isn't slowing down, with its tokenized fund, BUIDL, growing to over $2 billion in assets since its 2024 launch. In the latest video from the Ben Cowan channel, the discussion centers on the upcoming FOMC meeting and its potential effects on Bitcoin. The market is overwhelmingly expecting a 25 basis point rate cut, and any deviation from this would likely shock the markets. There's some chatter about quantitative tightening ending, but Cowan is doubtful, especially since assets like stocks, gold, and major cryptocurrencies are trading near their all-time highs. The analysis in the video holds up well against the current backdrop, as the market is indeed anticipating the first rate cut of the year at today's FOMC meeting. The CME FedWatch tool shows a 96% probability of a 25 basis point cut, making the video's core assumption accurate. Bitcoin is currently trading around $117,255, having shown strength by climbing from lows near $107,000 in late August. This aligns with the video's observation of a September bounce. The broader crypto market sentiment is neutral but improving, sitting at 53 on the Fear and Greed Index, with institutional ETF inflows remaining strong. However, there are mixed signals from analysts, with some predicting a continued rally towards $125,000 to $140,000 in October, while others caution that the end of a 4-year cycle could trigger a significant correction after a final peak. The potential for an S&P 500 pullback, as mentioned in the video, is a valid point of caution, as traditional markets can influence crypto, especially during periods of uncertainty. The key, as the video suggests, won't just be the rate cut itself, but the Fed's forward guidance, which will set the tone for risk assets like Bitcoin heading into the historically bullish month of October. In the latest video from Coin Bureau, Guy walks through a few key indicators to help traders navigate the crypto market. He starts with the 200-day moving average as a basic but effective way to gauge long-term momentum. A sustained move above this line, especially when backed by a real catalyst in growth and stablecoin supply, can signal a good buying opportunity. For spotting major market tops and bottoms, he points to two specific tools, the Pi Cycle Top and the MVRVZ score. The Pi Cycle Top indicator, which uses the 111-day and 350-day moving averages for Bitcoin, has historically been a reliable alarm for market peaks. The MVRVZ score measures if Bitcoin is over or underpriced compared to the average price holders paid. A high score suggests the market is overheated, while a low score has often marked market bottoms. Guy notes that with institutional players like ETFs now in the market, the Z-score might not hit the same highs as in past cycles, but it should remain a solid indicator for bottoms. For sideways, choppy markets, he recommends using the Relative Strength Index, RSI, combined with Bollinger Bands to identify potential entry and exit points. Throughout the video, the main message is that these technical tools work best when considered with the fundamental backdrop, such as ETF flows, token unlocks, and overall market sentiment. Patience is presented as the ultimate edge, advising traders to wait for high-conviction setups where technicals and fundamentals align. The video provides a solid framework for blending technical indicators with fundamental market conditions, a strategy that remains relevant. Looking at the current market, Bitcoin is trading around $116,000, which is comfortably above its 200-day moving average of about $101,416. Following the video's logic, this indicates that bullish momentum is still in control. This technical signal is strongly supported by the fundamental backdrop of U.S. spot Bitcoin ETFs, which have seen a massive $2.3 billion in net inflows over the past week, the largest weekly inflow in 3 months. This sustained institutional demand acts as the real fundamental catalyst the video suggests looking for. In the latest video from Crypto's Russ, the host discusses the big market shakeout and subsequent rally leading up to a much-anticipated Federal Reserve meeting. He points out that Bitcoin jumped back to around $117,000 as the market began to assume the Fed would take a dovish turn and cut interest rates. A strong parallel is drawn to last September, when an unexpected 50 basis point rate cut ignited a massive rally, pushing Bitcoin up over 77% in the following months. While a surprise 50-point cut is a long shot this time, he believes the coming rate cuts could be what finally unleashes Bitcoin to break its all-time high, which is only about $6,000 to $7,000 away. More than that, he suggests this could be the event that truly kicks off a widespread altcoin season, as a huge amount of money sits waiting in stablecoins on the sidelines. He does caution that there's often a temporary dip right after the Fed's announcement before the market reverses and heads higher. The host's anticipation of a pivotal Fed meeting seems to be right on the money. The market was clearly pricing in a rate cut, and reports leading up to the decision showed overwhelming expectations for at least a 25 basis point reduction. Currently, Bitcoin is trading around $116,000, holding the gains mentioned in the video as investors await the official word. The broader crypto market sentiment is bullish but cautious, with the fear and greed index sitting in a neutral to bullish zone, which aligns with the idea of money waiting on the sidelines. The video's comparison to the previous year's rally is compelling. A dovish signal from the Fed in an environment of slowing labor markets could indeed be the catalyst needed. If the Fed confirms a cutting cycle, it could validate the host's theory and encourage sideline capital to flow into both Bitcoin and altcoins, potentially triggering the altcoin season he mentioned. The market's strong rally ahead of the news suggests investors are positioned for a positive outcome. In the latest video from Crypto Banter, the host gives a full rundown of the KuCoin crypto exchange, calling it a reputable and secure platform. KuCoin serves over 40 million users across 200 countries, offering spot trading, futures, margin lending, and even DeFi services. The platform boasts a top security rating, holding an AAA rating, and provides audited proof of reserves. For new users, there are some hefty sign-up bonuses available through a specific link, including a $100 trial fund just for signing up and completing KYC. Additionally, you can get 100% cash back on your first $100 deposit, with opportunities to earn up to $10,000 in rewards. The video gives a solid overview of KuCoin's features, which seem particularly attractive in the current market. With Bitcoin hovering around $60,000 and Ethereum in the mid-$3,000, the crypto space continues to mature and exchanges are becoming more competitive. KuCoin's high leverage option of 125x is a powerful tool, but it's also a double-edged sword, especially in a market that can see sharp, unexpected movements. The KuCoin Earn program is another interesting feature, offering yields that are hard to come by in traditional finance. However, it's important to remember that these returns often come with lockup periods and are not without risk. The move to integrate a Web3 wallet is a smart one, as the line between centralized and decentralized finance continues to blur. This allows users to easily move between trading and interacting with DeFi protocols and NFTs. Overall, KuCoin appears to be positioning itself as a comprehensive platform for both new and experienced crypto users. In the latest video from Crypto Casey, she gives a step-by-step guide on setting up and using the Tangem hardware wallet. This wallet system uses cards instead of a typical device, letting you hold your own crypto like Bitcoin and Ethereum, as well as NFTs, taking them off exchanges. The setup looks straightforward. It involves tapping the cards on a smartphone and creating an access code. To show how transfers work, she moves $50 in Bitcoin from an Uphold account to the Tangem wallet. The video also covers the wallet's built-in features, which let you buy, sell, and swap different cryptocurrencies right from the app. Staking is another feature, with mentioned yields of 16.47% APR for Cosmos, 6.47% APR for Solana, 3.3% APR for Tron, 2.87% APR for Polygon, and 1.3% APY for BNB. Additionally, the tutorial shows how to link the Tangem wallet to decentralized finance, DeFi applications using Jupiter on the Solana network as an example. A key security point mentioned is that the private keys are generated and stored on the cards, meaning there's no seed phrase to write down unless you choose to create one, which is presented as a less secure option. The focus on self-custody with hardware wallets like Tangem is becoming more relevant as people look for more security. With Bitcoin currently trading at over $115,000 and Ethereum around $4,500, the need for secure storage is clear. The market is also reacting to regulatory discussions worldwide, including the markets in crypto assets, MiCA, regulation in Europe, and ongoing talks in the US and UK, which could change how exchanges operate and might make self-custody more appealing. The staking yields mentioned in the video are interesting, but it's good to remember these can change. For instance, current rates for Cosmos staking are hovering around 14.8% to 16%, while Solana's yield is closer to 5 to 6.8%, so the video's figures are in the ballpark but not exact today. The card-based, no seed phrase approach of Tangem is a unique way to address the security concerns that come with managing crypto, aiming to make it simpler for more people to hold their own assets. In the latest video from DataDash, the host lays out a theory about long-term market cycles, suggesting we're approaching the end of a major 20-year economic cycle that could lead to a global reset. He compares Bitcoin's current situation to that of gold back in 2004, the year gold's first ETF was approved. The core idea is that Bitcoin, having just gotten its own ETFs in 2024, might be on a similar 4-year path to a major cycle top around 2027 to 2028. The video's comparison of Bitcoin's post-ETF trajectory to gold's is a compelling long-term narrative, especially as institutional adoption visibly changes market structure. Since the launch of spot Bitcoin ETFs in the US, There have been massive capital inflows, with weeks seeing over $2 billion pour into these products. This sustained institutional buying, which now accounts for nearly 14% of Bitcoin's circulating supply, lends weight to the idea that the days of 80% drawdowns could be over. With Bitcoin currently trading around $115,000 to $116,000, the market is in a state of neutral sentiment, digesting recent gains while looking for its next major catalyst. In the latest video from Crypto Windy, the main message is that diversification in crypto is extremely important. The discussion centers around a CNBC interview with Dan Morehead, the founder of Pantera Capital. Morehead mentioned that while his firm's largest position is currently in Solana, he also acknowledged that Ripple XRP is making a serious run at Swift's dominance in global payments. He doesn't believe in a winner-take-all outcome and expects a handful of major Layer 1 blockchains to succeed long-term, pointing to Bitcoin, Ethereum, and Solana as top contenders. The video also features Morehead's prediction that Bitcoin could reach $750,000 in the next 4 to 5 years. The host wraps up by explaining that you can't really make a direct versus comparison between Solana and XRP because they are built to solve different problems. XRP is focused on revolutionizing banking, while Solana was created to compete with Ethereum in the broader world of decentralized applications. This distinction is precisely why holding a variety of assets is a smart approach. The conversation in the video, particularly Dan Morehead's perspective, reflects a significant trend in the institutional space, strategic allocation rather than tribalism. While Pantera is heavily invested in Solana, his public acknowledgement of Ripple's mission to disrupt Swift is noteworthy. Currently, Solana SOL is trading around $234, showing resilience and continued interest from institutional players, which lines up with Pantera's confidence. Meanwhile, XRP is trading at about $3.02. Its future is still heavily tied to its progress in the cross-border payments sector and the ongoing, albeit improving, regulatory landscape. Morehead's Bitcoin prediction of $750,000 seems bold, but it's a view shared by other major figures in finance based on its potential to capture a larger share of global wealth. The broader market is navigating a complex regulatory environment, with U.S. authorities slowly moving towards clearer frameworks for digital assets, which could reduce volatility in the long run. The idea that only a few key Layer 1 blockchains will dominate seems plausible, as network effects tend to create massive leaders in tech, and both Solana's high throughput and Ripple's specific use case give them strong positions in that race. In the latest video from The Modern Investor, the host discusses how the crypto market has matured from fearing bans to anticipating widespread adoption. A central theme is the rise of stablecoins, with numerous banks and institutions looking to create their own versions. He focuses on Wyoming's launch of the Frontier stablecoin, the first state-issued stablecoin in the U.S. This token debuted on 7 blockchains, including Ethereum and Solana, a move designed to spread risk. What makes the Frontier token stand out is its altruistic goal. Instead of profits going to a private company, the interest generated from its cash and U.S. Treasury reserves will fund Wyoming's school foundation. The host finds it strange that some in the crypto community oppose this, preferring profits to enrich corporations. The video also touches on the massive corporate accumulation of Ethereum. It's revealed that 69 different companies now hold over 4.1 million ETH, worth about $17.6 billion. The biggest holder mentioned is Bitmine Immersion Technologies with 1.5 million ETH. This corporate buying spree is seen as a race to acquire the underlying asset needed to launch future stablecoins and other blockchain-based applications. Wyoming's launch of the Frontier token is a significant development in the digital asset space, moving beyond private corporations like Tether and Circle into the realm of public-issued digital currency. This initiative serves as a practical test case for how government entities can use blockchain technology, potentially streamlining everything from tax refunds to contractor payments. as was demonstrated when a payment timeline was reduced from 45 days to seconds. The market is certainly ready for growth, with some analysts projecting the stablecoin sector could reach between $1.6 trillion and $3.7 trillion by 2030. This move also comes as the U.S. government establishes clearer regulations with the recent signing of the Genius Act, which provides a federal framework for stablecoins requiring 100% reserve backing with liquid assets. In the latest video from Alex Becker's channel, he explains that the current market pumps are just a small preview of the massive altcoin season he expects in Q4. He argues that a huge bubble is forming because trillions of dollars are set to move from money markets into riskier assets like crypto as interest rates go down. He predicts this flood of capital will cause ridiculous gains, making the recent 2-3x pumps on some coins look tiny in comparison. Becker then lays out a treasure map of 7 key sectors he believes will perform well. He discusses beginner-friendly, larger coins like Avalanche, Cardano, and Sway, and then moves into riskier, smaller-cap coins within specific narratives. The sectors he's focused on are DeFi, AI, real-world assets, RWA, robotics, DePIN, decentralized physical infrastructure networks, gaming, and memes. For each category, he names specific coins, such as Clearpool and Caspa for DeFi, and TAO and AOS for AI, explaining that the biggest gains will come from getting into these narratives before they become mainstream. Alex Becker's high-energy forecast for a Q4 altcoin explosion is based on the idea that falling interest rates will push trillions from money markets into crypto. This lines up with general economic theories that lower rates increase liquidity and appetite for high-risk assets. Currently, the market is showing some of this anticipated movement, with Bitcoin hovering around $116,000 and Ethereum near $4,500. His focus on specific narratives like AI, DePIN, and real-world assets, RWA, is timely, as sectors like DeFi and RWA tokenization have shown strong year-to-date performance. In the latest video from CryptoJeb, the host explains why Bitcoin's recent sideways trading is a healthy and expected part of a larger bullish plan. After rallying from $107,000 to $116,000, Bitcoin has entered a consolidation phase. This is seen as a positive development because it prevented a large gap from forming in the CME futures market, which would have likely needed to be filled by a price drop later on. The analysis points to numerous bullish signals, including an inverse head and shoulders pattern, a bullish MACD crossover, and strong support levels. The video suggests that this consolidation is forming a larger inverse head and shoulders pattern, setting a price target of $127,000. The technical analysis presented in the video aligns with a generally bullish market sentiment, which seems to be building. Currently, Bitcoin is trading around $115,000 to $116,000, holding steady after its recent push. The points about institutional interest are particularly relevant as spot Bitcoin ETFs have indeed seen a significant surge, with 7 consecutive days of net inflows totaling over $2.3 billion last week. This sustained buying from major players like BlackRock and Fidelity does suggest a strong foundation for the price. The Federal Reserve's FOMC meeting concludes today, September 17th, and the market has overwhelmingly priced in a quarter-point rate cut, the first since late 2024. Historically, such moves can stimulate assets like Bitcoin. With the latest U.S. inflation data for August coming in at 2.9%, slightly higher than previous months, the Fed's commentary on future policy will be just as important as the cut itself. If the Fed signals more cuts are likely, it could add more fuel to the rally described in the video. The altcoin engine theory is a classic crypto market cycle pattern, and if Bitcoin does break its all-time high, a subsequent flow of capital into major altcoins is a plausible scenario to watch for.